I'm Mike Graham, president of Midwestern Securities and your host of the Banking on Growth podcast. With us today, we have my friend, my business partner, and our chief compliance officer at Midwestern Securities, Jeff Weber. Jeff, thanks for joining us today.
Of course.
So you've been in compliance for decades. You've got a great tenured history of being in compliance. Compliance is a critical component of operating in the financial services industry. Compliance is actually one of the triggers why we formed Midwestern Securities in the first place. Back in the late 90s, our affiliate, our retail branch, was affiliated with another broker-dealer before Midwestern Securities existed. The other broker-dealer was 2 states away, and it was owned by a publicly traded company. And we were tired of a lag in service. And specifically, the summer of 1999, we were trying to promote a retirement income seminar. We sent the material, which was compiled and NASD approved, right? The predecessor of FINRA approved. All we were doing was changing the dates, times, locations, presenters. Sent it to our prior broker-dealer in June after countless follow-ups. Finally, in mid-August, found out that it was still sitting on the first person's desk. They had been ignoring it for almost 2 months. And at that point, I approached my dad and said, hey, maybe it's time. We're big enough. We've got enough going on that we form our own broker-dealer and bring some of that service that was lacking from a publicly traded partner in-house, with the idea it would allow us to free up time to spend more time being client-facing and being able to be more engaged and impactful to our end clients. So that's where we formed Midwestern Securities. We were tired of waiting on a publicly traded company multiple states away. And, we wanted more responsiveness. So again, we can have a bigger impact with our clients by being able to spend more time with them. I want to go into a lot of different compliance discussions with you today, but before we get into that, which includes timeliness of response and communication with financial advisors,
Of course.
You had a big June. Will you share with our audience a little bit about what you've been doing this month here and the importance of it?
Yes. I attended the FINRA conference in Washington, D.C. in May. And while I was there, I was approached to participate in a FINRA panel discussion on elder financial exploitation and abuse, which I had never done before. I was reluctant, but the recommendation came from a senior director with FINRA. So I couldn't say no. So I jumped at the opportunity and was a little hesitant, but we met as a panel 2 or 3 times prior to the actual live webinar. And then, yes, on June 9th, I flew back to Washington and we did the webinar live in the FINRA studios at their headquarters at 1700 K Street in Washington, D.C. They have a wonderful studio, which we were all in and did the presentation and then returned home. So,
well, it's an honor to be asked for you individually, and it's an honor for Midwestern Securities to be represented there as well, to be considered a firm that FINRA was comfortable putting out in the spotlight.
Yes. And I guess my part in the webinar was I was representing the small firm perspective, which about 90% of FINRA's members are small firms. So it was a huge honor, and it was a wonderful experience.
Yeah. Awesome. So what did you guys talk about on the panel, and why is that important?
28.3 billion reasons why it's important. That is what the AARP estimates. Senior exploitation, frauds, and scams losses are annually. and which is a huge amount, no doubt. However, that's what's reported. So I'm sure there could be twice as much that goes unreported. That's really the importance of the panel discussion, was to let firms know the resources that are available to try and prevent fraud. Um, my things are moving. I mean, with trades, we had a T+3 years ago. We're down to T+1. So money's moving faster. The scams are getting more sophisticated, and it goes from there, and a lot of elderly people may be embarrassed to talk about it. But it's important that firms know, it's important that reps know, it's important that reps share it with their customers. They are, facing the customer, talk about scams and what can happen. Because money, once it's gone, it's gone. Very difficult to even recover it all.
Jeff, is there a higher likelihood of senior exploitation coming from strangers or from friends and family?
Unfortunately, the majority of it is friends and family, caregivers, those with authority, like a power of attorney or a trustee for the actual client. That's the major source of it. And then others, come through email, comes through phones, and, with artificial intelligence growing rapidly, the scams are just becoming more sophisticated.
So we're in the bank and credit union space. How do our financial advisors and our partners and employees, how do they weigh in? What role is theirs in senior abuse and exploitation?
Being in a financial institution, they know their customers. They've dealt with their customers for years. I mean, the financial institutions we're in are local community banks and credit unions that have a reputation that they want to maintain. They know their customers. They deal with them, weekly, daily. And then the advisor as well. The advisor's there, and between the bank team and our advisor wealth management division, it's a good cohesive structure to give a heads up to our wealth division if something's going on with an account at the bank, that they know the customer has accounts with us as well. It takes a lot of collaboration and a lot of training, constantly training. I know as a firm, we do bi-monthly cybersecurity training. And it's all to keep everybody on their toes and make them aware that this is something that happens.
On the panel, you gave an example. Will you share that example with our audience as well?
I sure will. Yes. We had a customer. He opened an account with one of our divisions with proceeds from life insurance from his deceased wife. And the account sat for probably 6 months before there was anything done with the account. But the first transaction that really wanted to take place was the account owner wanted to withdraw $12,000. And that was to bring a woman here to the United States that was at the airport in the Philippines. And he had been to a couple branches of the bank prior to that, and, was very open with what he was doing with the money. And the bank wouldn't do it for him. And then he came to our division, which we had a heads up, like I said, and we did not do the distribution. And FINRA, as a regulatory body, is implementing rules that help us be able to deter clients from taking this kind of money out for these reasons. So we invoked that rule, which means we could hold the distribution for a period of days. And then after that time was up, we do release the hold on the account. And, I don't know that it specifically went out after that hold, but there were some withdrawals from that. So,
Gotcha. So this particular investor fell prey to a love scam.
yes, romance scam. Yep.
Gotcha. Jeff, that romance scam is a great one to share. Are there other examples of senior exploitation and abuse that you could share with us?
Yes, of course. Yes, one of the people on the panel, actually, she is the director of the investor education with the SEC. And she shared a story that a client had come in, talked to his advisor. They were going to take a vacation for his entire family, and they were going to Alaska. So he wanted to withdraw $100,000, which was not typical of him, but he assured the advisor that it was for the family vacation. Well, he lied to his advisor, and the $100,000 went out. And it was a crypto scam is what it ended up being. But in this case, crypto was not the problem. The problem was the scammer getting the client to do a withdrawal of $100,000 and send it to him. So he came in probably a few days after that, maybe at the end of the week, and wanted to withdraw $450,000 because the scammers, he looked at his account, thought his account was growing with the money that he originally took out. And then the scammers came back and wanted $450,000. He went back to his advisor and admitted that he lied for the first $100,000. So they were able to stop the $450,000, but the $100,000 was gone and unrecoverable. So,
yeah, thanks for sharing. These things are the financial advisors, the community bank, the credit union. They're very close to the customer. They need to watch and listen, but then they need to have confrontational, awkward discussions where we've got to challenge and we've got to push on these things.
Yes, especially when when withdrawals are not typical of a client. I mean, that should be an immediate red flag for an advisor or any employee at the banks, that it's like, this just doesn't seem right. And do the gut check. If it doesn't feel right, then slow down and really dig into why the money's being withdrawn.
Sometimes compliance rules seem like rules for the sake of rules, but this is certainly a very personal, very important aspect of compliance, that when you save and you mitigate risk, it has to be very rewarding.
Yes, it is. And like I said, the panel provided many resources through FINRA, through the North American Securities Administration Association, through the SEC. There are resources available. And like I said, FINRA has implemented these rules with the intent of being able to try and help stop the scammers. If not stop it, at least put a hold on anything from happening for at least some time, to be able to investigate what's going on.
Okay. Let's switch gears a little bit to just general overall compliance. Will you explain the role of compliance management in ensuring regulatory adherence and mitigating risk? And maybe, since we're in this unique space of being in the bank and credit union space, specifically how that risk may be different than just an independent financial advisor.
Yeah, at a firm level, it all starts with oversight and supervision. I mean, FINRA and the SEC develop rules. Then we, of course, our first review of those rules is to, how does it affect our firm? and then put procedures in place that are designed to comply with those rules. FINRA and the SEC always are good with, they won't tell you how to do it. They just tell you what we have to do. So it's our interpretation. And with the team we have here, I mean, I'm going on my 30th year in the business. We have a pretty good team. I mean, we have one of the best, in my opinion, right here. And we just all work together, develop those policies, and then educate. Not only our home office employees, but the advisors as well, their assistants. And I mean, we train bank employees as well about our program and the value that we bring. So compliance is first, always. And at our firm starts at the top with you. I mean, we just run a compliant ship here.
Yeah, we have the saying, compliance is king.
Yes.
So a lot of, I think a challenge in financial services is communication, and it's a challenge in every component of life in every industry. But especially when you have businesses within businesses, you have investment divisions within banks, for example. It's what I'm referring to as a business within a business. The communication is extra important, that it gets all the way through to the leadership team, to the from the advisor to the program manager to the bank president to the chairman of the board. We see lots of banks who work with publicly traded broker dealers that they've never had somebody from their broker dealer in their bank, and they don't have that communication flowing through the institution. Will you talk a little bit about the importance of that institution, that communication flowing through the institution, and how it should be done?
Yes. Communication is key. And I think that we have about 40 advisors. 35 of them are in financial institutions. We partner with those financial institutions. We create a program and want to work with the bank to not only improve the bank's bottom line, but retain their customers and keep that relationship that they've built up over many, many years. Large firms, I don't know if, I mean, I know with our firm, compliance, our phones are open all the time. If somebody needs to talk to me, they have my phone number. If I need to talk to somebody, I call them and work with the bank partners. If I need assistance, just to communicate and say, this is how it needs to work. And let's work on it as a team and have a successful program.
I would guess that you've met almost all of our program managers or presidents at some point at a rep meeting, them coming into town, or in an audit of being on site in one of the institutions, and potentially have had individual follow-up calls with them after audit reviews to make sure that they understand if they got an A or a B, or what needs attention.
Mm-hmm. Very much so. Yes, we have a lot of meetings throughout the year, and gives us the opportunity to meet with our partners, the advisors, and it's just a good relationship. Totally different than the large firms. It's just we're hands-on, and I think in the community banks and credit unions, they're hands-on with their customers as well, and it's a good working relationship, and it's first name basis, and it's a good business and relationship to be in.
Yeah. First name basis is great. Can you share an example of a situation where you or your team identified a compliance risk or violation and successfully addressed it within a wealth management division or entity?
Yeah. Trying to think which one. I don't have very many. That's the problem, which is good. I like I like that. But um, I can go back to one that happened a while ago. I was not at this firm, but it's a good story to share with. We had an advisor who was working with a client, and we were still in financial institutions with my original firm that I started with in the industry. We were also in financial institutions, and he was working with a client, and then she was recently widowed and very young, had a young boy, and just needed assistance paying bills and doing stuff like that. So the rep um, added his name to her bank accounts as an authorized signer. That was discovered through email review. In fact, I mean, as registered people within the industry, you're not supposed to use your personal email to communicate with clients because we all archive all of our emails here. But he used his personal email, so we were able to discover it through there. And unfortunately, that one ended with the rep's termination. Fast forward to Midwestern Securities. We've identified a few situations where we had to put reps on heightened supervision, which is a process. If you have a rep that is doing something consistently incorrectly and won't change, then we take efforts from our side to mitigate that risk and put them on heightened supervision for a period of time to solve the issues. We meet with them regularly. We require them to do additional things, including continuing education throughout the program, and it generally lasts 6 months to 12 months. And then it's over and things have improved. Otherwise, we will continue the program. So we've had to do that a couple times here. So, which you don't like to do it, but you have to do it.
When you do that, does the financial institution president know about it and know the outcomes?
Yes, of course. Up front, knows what's going to happen. We walk through the plan with the president of the bank, and this is what we're going to do. And then when we have our initial meeting, it includes the advisor as well as the bank leadership, so they know the reasons why, and they know what went on and what we're doing to fix it.
So let's talk about audits a little bit. How frequently do branches need to be examined? And what sort of things do you look for, especially in a financial institution?
We do audits annually. This year in 2025, we're not required to do them all annually. We can put them on a 3-year cycle. So this year we made the decision to allow some to be on the 3-year cycle. And then some are still annual. Since COVID happened, I mean, many of our audits are done remotely, but we do face-to-face audits in a sample of our branches. We do that. So what we look for during those audits are record keeping to make sure they are following the procedures to keep their records and how they maintain those. With us being in banks, there's got to be a hard line between our services that we provide and the bank services. So we maintain space on the bank server for our files that are necessary to comply with the rules. We look at that. We look at their sample emails, to see if they are archiving them and not using personal text to communicate with their clients. And then, look at client files, see if the paperwork's in order, all their notes of their discussions with their clients. Documentation is key in this industry. If you would have a complaint or dispute with the customer, it's going to come back mainly to the documentation you have. including all notes and conversations with your customers.
After you complete an exam, then how do you communicate the results with the leadership?
We use a system that will flag responses that are outside of our acceptable answers throughout our audit. And that final report is produced and given to the rep initially. And they are to address any outstanding deficiencies. And then once that is complete, we provide the bank leadership with a final copy of the audit, which, being in banks, we're familiar with our regulations, but we also have to be up on the banking regulations as well, because, we're required to audit it, and the bank, their regulators are going to want to see us audit their programs, and they're going to want to see the results. So there's a formal written report that's distributed.
Jeff, how do you measure the effectiveness of a compliance management program? What key metrics and key performance indicators do you consider most relevant in this context?
I think it comes down to the regulatory exams that we go through. At Midwestern, we're subject to a routine cycle exam every 4 years. And I always like to get to the point where we're not going to have any exceptions in the audit. My first audit with Midwestern was in 2020. And we had a couple exceptions that we dealt with immediately and took care of. Our last one was in 2024. And this one we did way better as far as any exceptions were going. But it takes time. These audits, our exams with the regulators started in January and it's done at the end of July. So it's spread out over a period of time, but that really gives me the satisfaction to get through those regulatory exams and have very few exceptions. And this last one, it was very minor. But throughout the year, other than those exams, we have a scorecard that we keep track of on a monthly basis, and it tracks all of our activities, and that's what we review weekly in our meetings, and it kind of keeps us on track. How are we doing? What can we improve on? And go from there. So those are the things that I use to measure.
Thank you, Jeff. So you measure the effectiveness of the compliance management program by good audits, by a lack of regulatory disclosures, perhaps also through a lack of customer complaints, because our reps are trained in following the process. I remember early on, you mentioned Midwestern's on a 4-year cycle. I assume that firms that have compliance issues are not on a 4-year cycle. FINRA may have an office within their office, and there's certainly, they're much more frequently than what a 4-year cycle might be perceived as. So FINRA may come in, the SEC may come in, the state may come in from time to time as well. But it's great to be on a 4-year cycle, I think.
Very much so. I know the firm that I worked at before I started with Midwestern. I think they had a FINRA office in their building. They were examined every year. So when you're being examined every year, you are a risk in the industry that FINRA is going to watch way, way more closely than a firm like us, because it's our reputation, and it's documented. There's, no customer complaints. There's no disclosures at the firm level. It's key, especially when we're going into community Financial institutions, I mean, their reputation is everything to them too. We are very open as a compliance team, but we do run a tight ship.
Jeff, if there's a financial institution executive listening to this podcast and they wanted to do some research on a firm's compliance history, how would they do that?
They can go to BrokerCheck, brokercheck.org, I believe. They can look at us as a firm. They can look at any associated individuals that we have, and it will give a history of the firm, as well as if there's any disciplinary history. That's the source for that. But like I said, I'm very proud. I think we're all proud of the record we have here at Midwestern, and it's in our blood to keep it that way.
Yeah, that's a great way to summarize it. Jeff, I really appreciate you taking time out of your very busy schedule to share some of your insight and experience with our guests. So thank you again for being with us today.
Yeah, no problem. It's nice to be here, Mike. It's good to share. It's good to share our story.
Absolutely. Absolutely. All right. Well, thank you, Jeff. And thank you to our listeners. And on behalf of all of us at Midwestern Securities and Banking on Growth, thank you for joining us. And until next time.
This has been another insightful journey with Banking on Growth with Michael Graham and Midwestern Securities, a member of FINRA and SIPC. We appreciate your time. If you found value in today's discussion, consider subscribing for more thought-provoking discussions in the world of finance. Your support helps us continue to bring you quality insights. If you have a topic you'd like us to consider covering or have thoughts on one of our episodes, we'd love to hear it. Just email us at media@midwesternsecurities.com. Remember, the power to grow is within you. Thank you for being a part of the Midwestern Securities community. Until next time, stay inspired and keep banking on growth.